first talk of the day, it is a pleasure for Sintercafé to welcome back Mr. Keith Flury, a longtime friend of the event. Mr. Flury is Sugden's head of coffee research and analysis. He has been an agricultural and commodity researcher for over 20 years and has worked in retail, banking, trading, and consultancy roles regarding coffee business. His first interaction with the coffee market was as a barista at Café Roma in Davis, California. So we're looking forward to see his arte latte skills. Good morning and welcome, Mr. Flury.
Good morning. My name is Keith Flury. I am the head of coffee research at Sugden. We are a coffee trading firm based in Amsterdam, but with offices, of course, globally. I want to thank the Sintercafé organizers for allowing me to come back. It is lovely to be back, and it is very nice to be here again. They have asked me then to go through the supply and demand dynamics of the global coffee market, but they have only given me 30 minutes to do it. So I'm going to have to be relatively brief, and I will not be able to focus necessarily on each individual minutia of the coffee market, but try to get an overall view of what is occurring and what our outlook is. That is, I'm going to try to look forward by looking backwards. But we all know that the coffee market is difficult to know at the current side. So it's going to be, of course, a little bit of a question. We're going to start with supply, and with supply, of course, we're going to start in Brazil. There is a lot of production volatility in the global coffee world, but much of that production volatility is in Brazil. Now, there is a function of the on-off season cycle, but then there is clearly also a function of weather events that occur in Brazil. Now, we've had two of these weather events in the last 3 years. What we're looking at here is the production of Brazil in black and the exports of Brazil in blue. This is all Arabica. You can see here the two diminished crops because of frost and drought, and this is the current crop that has just recently been harvested. We think 43 million bags. There are still quite a lot of varying views on what that production number is, but much of the market is already focused on the next year's crop. That can be problematic at times because trying to price in something that is theoretical means that the market needs to continuously adjust. For us, we note that rainfall in Brazil, and here you have rainfall in the upper right on a 10-day accumulated basis, has been relatively good in October, but two things worry us. One is rainfall at the end of August meant that there was a level of flowering that is quite early, and that probably may have resulted in some reduction in the output potential. And we note that September was increasingly warm in Brazil. It was very warm globally, and Brazil was no exception. However, we still anticipate that next year's crop could reach 50 million bags. We need to confirm this with crop tours, because right now, again, it is a very theoretical number, and of course, we need to see the rainfall over the next 6 to 7 months. If rainfall is good enough until March 2024, and there are no other extenuating circumstances, we anticipate then a relatively large crop, which you can see here at the end. It's interesting, the production volatility of Brazil is huge. It can vary by 20 million bags year on year, but the exports of Brazil are relatively stable. We think the world needs around 34 million bags of Brazilian Arabica every year to meet demand. You can see here over the last 6 years, the export flow has varied only about 2.5 million bags above or below that number. Which means even when there is a massively lower crop, the Brazilians do a good job in exporting inventories that they had from previous crops. And when there's a very, very large crop, the Brazilians do a very good job in holding that crop in Brazil and not flooding the international market with it. That's, of course, a function and a dynamic of the price in the market itself, but it is an interesting dynamic that allows there to be a little bit of a buffer. Now, Brazilian production aside, let's look at the total Arabica world's production. And there's an interesting dynamic in the sense that Arabica production that is not Brazilian has been falling steadily for about 6 seasons. That reduction, of course, is a function of the market, prices, and a function of input costs, likely fertilizer and a number of other things. So you have in blue the non-Brazilian Arabica, and you have in black the Brazilian Arabica. You can see here we're anticipating in 23-24 that uptick, and we also anticipate in 23-24 a slight increase in non-Brazilian Arabica. Now, this is important because, again, 6 years of deficits or 6 years of reducing mild production has really shifted the demand dynamic with regards to type of coffee. Now, this production increase in 23-24 is mostly a function of an increase in production in Colombia. We think that más o menos, most of the other Arabica producers will have around the same amount of coffee they had last year. But the Colombian production we anticipate at over 12 million bags, which is definitely different from the 10.8 million bags they had in 22-23. Now, you also see here in the upper right, the fertilizer price. The fertilizer price versus the New York Arabica price in blue, and the export flow of milds here in black. And you can see that the fertilizer price generally has a lagged reaction with regards to production. This is similar to what we would anticipate these days, but when the fertilizer price was high, New York price was relatively high, and they have both come down. Fertilizer prices have come up a little bit, but so have New York. My point is being that it's been very difficult for non-Brazilian producers to take advantage of the last couple of years of relatively high prices because input prices have been high as well. Let's take a longer-term horizon here and look at the coffee world split by type. This is annual production by Robusta, milds, and Brazilian Arabica. And you can see a very, very clear trend. First, I want to show you Robusta, which goes from 30 million bags in '94 to nearly 77 million bags in 2023. Milds, which remain relatively flat, and Brazilian Arabica, which also grows. I have thrown in the linear trends and the equation with that. So you can see that on average, over the last 30 years, Robusta production has grown 1.7 million bags a year. Brazilian Arabica production has grown 838,000 bags a year. And milds production has grown about 300,000 bags a year. And if you take out the bump of 2016, 17, 17, 18, which was a very large couple of Honduran crops, mild production has basically been flat for 30 years. Now, this is a function, again, of the market, the demand, the cost of production, and everything else that goes into deciding where crops are going to be grown, where they're going to expand, etc. So let's take that dynamic and look at the demand. This is a similar slide, but what I'm looking at here is only consumer demand. Think United States, North America, Canada, Europe, and Japan. What I'm looking at is the 12-month disappearance of coffee by type. Now you can see in 2021, interestingly enough, all 3 types were very, very similar. So the 12 months prior to that, the world had used the same amount of Robusta, Brazilian Arabica, and mild Arabica. Now, interestingly enough, that had a lot to do with the fact that there was a freight crisis, so Robusta was very difficult to get. There was a number of other dynamics with regards to foreign exchange, etc. But what I point out now is that over the last couple of years, so let's say the beginning of the end of the COVID to the point where we are now, Robusta demand on a 12-month running basis is about 10 million bags more than mild demand and Brazilian Arabica demand. We'll talk a little bit more about the dynamics of demand again in a second, but what this tells me is that the world has been focused on buying coffee that is the cheapest, and the cheapest is Robusta. And that is why you see that moving ahead. Now, if we're to extrapolate that forward, It's going to, of course, depend on the market. The market dynamics in the next couple of years may shift a little bit, reducing the demand of Robusta and bringing up Arabica. But what we can also see is that the naturals have really started to eat away market share for the other Arabicas, while the milds have been relatively flat. Now, if we take that in mind and aggregate it to include all of the world's consumer demand on a 12-month basis, we see some interesting dynamics. There have been some interesting bumps. So again, 12-month disappearance on a rolling basis for the consuming world. In 2019, the price of coffee was quite low, and you had a very good carry in the Arabica market. So there was an absorption of coffee to an extreme. Then COVID began. People used that coffee level, and then we saw a sort of knee-jerk reaction to a number of things that happened in the market, including the war in Europe. What essentially has happened then over the last 12 months, though, is that roasters and the entire supply chain, because of the structure of the Arabica market, have been destocking inventories as fast as they possibly can. Now, there's two things going on. One is demand, and two is consumption. Demand and consumption are two different things. Demand is when you buy coffee. Consumption is when you drink coffee. The world's demand has suffered over the last 12 months because roasters are running their inventories down, the kitchen is running their inventories down, even trade is running their inventories down. This means less coffee is being bought. That is being felt at origin. That impacts the overall differentials and even has an impact on the New York market. Consumption is different. Consumption has changed since COVID and during COVID, because what we are doing now is we're consuming coffee at a much more efficient way. Instead of drip coffee with a fair amount of waste, each coffee cup is measured through a machine, and there are less ounces for each machine. This is a material amount of coffee. Could be measured in hundreds of thousands of bags, even for a country like the United States, in 1 year. What does that mean? The coffee demand structure has changed with regards to how it is produced, reducing that demand, and it has changed in a temporary situation as inventories have contracted. Now, trying to foresee the future, it seems to us that the inventory levels will get to a comfortable point sometime in either this quarter or more likely at the beginning of 2024. That means in 2024, when a roaster sells 2 bags of coffee, he will have to buy 2 bags of coffee, as opposed to the current situation when he sells 2 bags of coffee, he only needs to buy 1 because he's actually running his inventories down. This is why we have this outlook with just a little bit of a tail then. Now, it's difficult to foresee and anticipate the bottom of this demand sink phenomenon, but what we really think then is that in the next couple of months, the inventories will be at such a point where we will grow organically again, similar to the levels where we were before. That being said, the hole that was dug over the last 12 months is significant. Instead of absorbing 114 million bags a year, the world is now consuming about 107 million bags over the last 12 months. That has been a significant reduction in the overall demand, and clearly a dynamic where the futures market is having a little bit of a bearish signal there. Now, on the mild side, there is even more somewhat negative implications. So we can look at demand by type by looking at the market and the flow. This is the 12-month net trade of the American milds. And I'm including Peru, Colombia, and Central America here. And you can see we are now, at the end of September, at a level where we have been in 2010. So if you had told me a year and a half ago that the net export flow out of the American milds was going to be 24 million bags, I would have told you that the differential was going to explode, and even the New York market would have a reaction to that. The differential, here you see the Colombian and the Honduran one, monthly averages, did explode. But more a function of the fact that shorts needed to find coffee, and less a function of the fact that there was a wholesale demand. And so what occurred is that demand destruction. So when the Colombian differential, for example, at 80 over, and the flow was still 30 million bags, clearly roasters went to other origins to find coffee. And you can see then the differential collapse from 80 all the way down to somewhere probably now in the, I don't know, whatever you think, maybe even the single digits, probably somewhere between 10 and 20 cents over New York. Now this is a clear signal that that demand destruction has occurred. 24 million bags of net trade out of the Americas is amazing, considering that 3 years ago it was 34 million bags. This is also a function of the fact that imports into Central America, Colombia, and Peru have now reached nearly 4.5 million bags per annum. This area is now becoming a major importer of coffee. That means that on a net trade basis, you're going to go lower and lower. What can we say about the future? One, it's probably unlikely that we see a whole lot more weakness in the differentials, simply because we're going to butt up against the demand of the certified board, and this trade flow at 24 million bags is likely to increase in the next year. In the next 12 months, we're going to have a bigger Colombian crop, which means, in theory, that that coffee needs to go out of that country. That means that the milds need to build demand, really for the first time in 6 years. And in order to build demand, you're going to have low differentials, even if you have a low New York market. Much of the shift of demand in the world between Robusta and Arabica happens in Brazil. This is the share of Robusta used in the local blend in Brazil. This is the arbitrage locally, and this is the Arabica price locally in Brazil in reais a bag. The Brazilians consume 21 million bags of coffee a year, and the demand can shift between 4 million bags between Robusta and Arabica, helping the global dynamic shift if there is a surplus or deficit. In the last couple of years, we had a major deficit in Arabica. The Brazilians consume much, much more Robusta, making almost 85% of their local blend Robusta. Now is a situation where the market is equalizing somewhat, and potentially over the next season we will have slightly more Arabica than we will have Robusta, which means that this dynamic probably needs to continue to come down, and the Brazilians need to produce and consume more Arabica. So I've tried to give you a little bit of an overview of supply and a little bit of an overview of demand, but there's always other things happening as well. And one of them clearly is the certified stocks in New York. The certified stocks in New York, for me, are a measure of the overall fundamentals, but they are a lagged measure, because generally when there is a Arabica or Robusta deficit, the market needs to minimize demand, it needs to use spot coffee, it needs to use origin inventories as well, and that is measured through the FOB. And then, kind of at the end, it also needs to use the certified stocks. The certified stocks in Arabica, you see here, are sitting around 300,000 bags and have been dropping very quickly, 137,000 bags in the last 4 weeks. If you look clearly, we are at a low that we haven't reached basically since the end of the 90s. And you can also see the dynamic where in blue, these are milds, and in orange are Brazils. The Brazilian flow to the board, which has now been allowed by the exchange, has shifted that market to now reflect the Brazilian balance sheet much more than it reflects the non-Brazilian Arabica balance sheet. It also means that the certified stocks are going to ebb and flow depending on the supply of Brazils. Clearly, we have had 2 major deficits in the last 2 years basis the Brazilian situation, and that is why, in my opinion, we are seeing these certified stocks now, because their value versus what's available, coming down. And if I look at the outlook, it seems over the next short-term period, there is not going to be a resupply of this coffee. In fact, the real resupply of the certified stocks will probably be the Brazilian crop next year. Now, I'm not saying that milds over the next 6 to 9 months won't go to the board, but the volume of milds that is available for the board is nothing like that will be available from Brazil. I just showed you the net trade out of Central America, Colombia, and Peru of 24 million bags is not sufficient enough to add millions of bags to the certs. The Brazilians have that potential. That means then that and a number of other rule changes in the certified stock means that the certified stocks will move with the Brazilian production. We have a surplus next year, theoretically, potentially restocking this. But over the next 10 years, 20 years, the next frost, the next drought, and the next supply disruption in Brazil will probably result in this market drawing these certified stocks down again. So the 10 years that the Arabica market existed in a full carry, and this is the front month spread, are likely gone because the production volatility of Brazil is much higher than the production volatility of other milds, which means that in the next 10 years, if we assume there will be a production supply constraint in Brazil, and I assume it probably will occur, we will probably see the front month curve go back into an inverse, maybe the whole curve like we saw last year. That means that trade and a number of other people who are used to a carry in the market and have built a business model around it will have to adjust to that, and that is going to be difficult. In the end, as I mentioned, the certified stocks are really driving the short-term dynamics in the New York market right now. And as far as the solution to them, we don't see that really until Q1 or Q2 of next year. So in the end, and these are relatively simplistic and aggregate values, we anticipate that 2023-24 is going to see a surplus of Arabica and a deficit of Robusta with the current prices we have now. That's just the beginning of the market, just the beginning of the season. If we actually anticipate then that the market is going to adjust to take care of this in the sense that the arbitrage is going to go low, we could see more demand come out of Robusta and go into Arabica, which means you will see the market adjusting that figure to a lower surplus of Arabica and a lower deficit of Robusta. This is what I anticipate, but this is based on prices today. Now, the fundamental dynamics of the market are one thing, but we have to remember that the price discovery mechanism that we use in coffee is the futures market. And the futures market is a dynamic of the supply and demand of futures, which is not coffee. The two are related, absolutely, but they also are different. Now, I'm going to look a little bit now at the positioning paper-wise of the New York market. This is the COT, the Commitment of Traders Report, released every Friday today by the United States government. It gives you a position of where the speculators are and where the commercial dynamic is as well. Here you have the commercials. So what I want to point out in orange is the commercial short. This is the hedge flow from origin, usually made through trade. And in blue is the roaster, who is basically just covering on the paper side. And in black, you have the New York price. Now, I want to point out clearly the roaster, who in 2019 took advantage of a relatively low New York market. Remember, we sat at $1 between 2019 and the early part of 2020. The roaster had a level of around 130,000 bags. Then the frost, the freight crisis, logistics issues in Brazil, lower destination stocks, popped the New York market from $1 to basically $2.40. And the roaster cover actually maintained a fairly high level. Now, I know it has gone down from 130 basically to 100, But to maintain 100,000 lots of cover when the market was nearly $2 means that the roaster was worried about supply. What has happened since then is that the market has gone from $2.40 to a $1.60, $1.70 that we have now, and the roaster has really let the cover drop between 40 and 60,000 lots. The roaster is constrained in holding inventories not just on the green coffee side, but also on the paper side. Also, potentially, the roaster has a sentiment about where this market may or should go, and therefore is trading based on that. The lack of roaster buying, and you can see them down here, and this is updated only till last Tuesday, because we have to wait for today's report, is minimal. So there is a dynamic on the commercial side where the buyer on the commercial side really has been very he's not been missing because the roaster is always short, it always needs to buy, but he has been able to maintain a relatively low level of cover. And when the market comes down, he buys, but they don't buy huge amounts of quantity, which is an important dynamic with regards to how this market has been able to sort of not stay at high levels for very long. Now in orange, you can see clearly the level of origin selling going from 200,000 lots all the way down to 100,000 lots. The little pop we saw at the beginning of 2023 brought in some selling. Over the last 4 weeks, and I assume the report will show us a similar thing this week, the origin selling has been around 7 million bags. So the market has gone up 15 cents, and it has pulled out 7 million bags of coffee. This is illustrated here. What I want to show you is how much origin has sold per 1 cent on the New York market. And the level of selling over the last 4 weeks is very similar to the level of selling that we saw in the beginning of 2021. This is important because the commercial law short has been a very supportive factor for New York by really not selling into this market. But that has shifted recently. And whether that is Brazil's, whether that is some milds coming onto the market and selling, Peru's, it's a combination likely of all of them. But what we have found clearly in the New York market is a level in which we find selling by the commercial short. This is a passive dynamic, but at the same time, a bearish dynamic. If we look at the speculator side, and here there are a couple of interesting dynamics. We have New York in orange this time, the speculative long in blue, and the speculative short in black. Now I want to show you one thing. First is the speculative long. This includes the index long, by the way. It has been relatively flat. Now I know there's always ups and downs a little bit, but somewhere between 80,000 lots and 120,000 lots, it has existed there for nearly 2 years. So we talk about speculators, but in the New York market, the speculator that is long, who is buying this market, has actually been unengaged in the last year and a half. And that may be a function of the macroeconomic world as a whole. It could be a function of the fact that the New York market, on average, is higher than it usually is. I don't know. Much of this trading is not based on the fundamentals of coffee, but the signals that the market is telling these computers to do. On the other side, the short, you can see the short during the frost stayed relatively small at 40 to 30,000 lots, and then exploded at the end of 2022. Now, in all intents and purposes, it seems like they lost money because they were bounced out, and then they went neutral again, and then they started selling at the beginning of this summer, and then they reached a level of, again, around 80,000 lots gross short. So the speculative gross short is the real engaged actor in this market. They have sold it, and then they get squeezed, and then they have to liquidate it. The market goes down, and then it goes up. This is exactly what we've seen in the last couple of weeks. A speculative short position of 80,000 lots needed to get out of the New York market as quick as it possibly can, and the market was up 30 cents. Now, it needed to get out because signals were telling it that this market, there was something an issue. Clearly the structure, clearly the certified stocks, clearly some other dynamics with regards to the flow running averages. There's a lot of different metrics these guys are using, but clearly their buying has helped this market then above $1.70. Now, their position now is very, very neutral, but I anticipate that in 2024, these guys, again, will be the main driver of the flat price in New York. For better or for worse, that price discovery mechanism that we use then is really being managed by a money flow that is looking at fundamentals very, very little and more looking at the dynamics and the signals of the market. For the moment, they are out, and we are above $1.70. And like I said, in the short term, there are a lot of dynamics to this market that need to be solved, and I don't anticipate them to really pile in yet. But in the new year, they could certainly be coming into this market again in force. Remember, if it's 40,000 lots they sell, you can equate that to somewhere between 20 and 40 cents. So I've tried to give you a little bit of an indication of what we are seeing with supply and demand. Our balance sheet, relatively balanced in the current year, but we still, of course, have deficits of the past 2 years, and those are still being played out in the certified stocks and, in some ways, in the destination inventories in general. Demand is down, but what we think is much of that demand loss has been a function of the inventory reduction that we've seen over the last 12 months, and we are hopeful, and in theory we believe, that over the coming months we're going to start to see demand level out simply because that inventory de-inventorying program is going to be mostly over. The outlook then is always problematic in coffee, but what we think is that on the short term, clearly this market still needs to solve, in some ways, the certified stock situation. So measured in weeks, the flat price and clearly the structure are going to be dealing with the fact that our certified stock inventories are at 25-year lows. And again, in the late 90s, when the certified stock levels were essentially zero or averaged around 100,000 bags, the New York market averaged $2.50. So it is actually, in some ways, now underpricing the dynamic of the fact that we are seeing certified stocks drop, and we don't see a huge amount of inflow of certified stocks in the coming months. On the opposite side, the outlook, in theory, of the next season is probably one of a large surplus given the Brazilian crop. Now, the Brazilian crop is looking very good on paper, but again, we have 7 more months of rainfall that need to occur. And I don't need to remind anybody here that the weather situations in the world are anything but calm. And that erraticness and risk means that this market will probably try to price in that crop, but at some point may overprice it. And in the end, we may not actually know the full brunt of it until we are actually in March. So from our dynamic then, we see a little bit of an upside, volatile situation on the short term, but if we see everything go well in the longer term, medium term, we would see a lower price, and or with the caveat that there are, of course, risks. Now, other things to keep in mind, of course, and these are beyond the scale and scope of my presentation, but on the fundamental macroeconomic side, things are relatively unsupportive. Also, the fact is that we think that interest rates will still remain relatively high. These sort of things are going to have the dynamic in the market as well. I hope I have been able to give you a little bit of insight into the fundamental dynamics of the New York and hopefully even the London market. And of course, if there's any questions, you can find me at the party tonight. I wish everybody a great day, and I hope I was useful. Thank you.